Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. As usual, with me today is Jonathan Charlo, who is also one of our partners and lead analyst. As usual, a copy of today's webinar materials will be posted to SilverOak's website following the webinar. It usually takes us 3 to 4 days to get that up on the site. The webinar today is expected to be 50 to 60 minutes in length. And if you're running other applications on your computer, that may cause some interference with the audio. So if you have any issues with audio, you may want to close down those other applications. If you have any questions regarding the material to discuss today and would like to reach out to your SilverOak advisor to have a conversation around those items, feel free to do so. We're all here and happy to address the questions. If you're not working with the SilverOak advisor, feel free to contact me directly at 952-896-5701. And I'd like to take this opportunity to thank Jonathan and John and the rest of our team that make this webinar possible. There's a lot of work that goes into it, I know, each quarter. In today's webinar, we will not be discussing specific SilverOak portfolio performance since each of our portfolios are customized. However, quarterly reports have obviously been sent out, and we have been reaching out to each of our clients as changes are needed in their portfolios. For compliance reasons, I must note that we will be discussing the overall markets and economy during our webinar today, and in doing so, providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Lastly, past performance is no guarantee of future success. So with all of that housekeeping taken care of, let's look at the agenda. We will start off the discussion around economic data for the quarter and then transition into a review of the market data for the quarter and really even for the last year as we look back. Then we'll provide some insight into SilverOak's outlook going forward for 2017. And we have a special section today where we're going to discuss the SilverOak Market Dashboard. And we'll talk a little bit more about the dashboard later, but it is a tool that we've developed internally to help us gauge where we are in the economic cycle and the market cycle. We'll transition from the dashboard into a discussion about the international markets and making sure that we have good diversification and exposure into markets outside of the U.S. Being that this is the first webinar of the year, we also have 1 or 2 slides on reminders so that we can all start the year on a good note. And of course, we like to start the webinar also with any questions that came in from either the past webinar that we had or in anticipation of the existing or current webinar. This quarter, I don't believe that we received any questions prior to the webinar, but this is a nice reminder that if you do have any questions, again, reach out to your SilverOak advisor after today's discussion. But if you have topics you want us to discuss going forward, you can also send us a reminder about that. So Jonathan, let's start with the economy. And you say here modest growth during the first quarter.
It was an interesting quarter. When you look at the hard economic data that's come in the first quarter, it's showing modest growth. But we also have some slides where we'll review this, but what we're calling soft economic data, surveys, confidence, things like that, that's much higher. So there's kind of a dichotomy between what's actually going on in the economy and people's kind of sentiment and expectations. When we look at the current economic factors, We don't have any changes between the positive, neutral, and negative items. We are seeing some improvements in China, and you had mentioned that international is an area that we'll talk a bit more about. So that's very important since China does make up a good bit of global growth and has been a negative factor. So we did put a positive red arrow on that, but no other changes. Now there were two data points that came in recently fairly negatively, and we'll talk about that a little bit when we look at GDP. But auto sales growth has really come down. No real acceleration. And then the other thing that we've seen in the first quarter is that bank lending growth really did fall down. And that was really more of a factor of demand by small and mid-sized businesses versus the banks themselves. So all in all, no major changes, and we'll kind of talk about that difference between soft and hard data.
Sure. And you mentioned the GDP growth. So we have a slide here that is titled GDP growth weakens because the number just came out this morning for first quarter and it wasn't great.
Yeah, it came in at a growth rate of 0.7%. In fact, that's the lowest growth rate we've seen in the last 3 years. And that did decline from a 2.1% growth rate in the fourth quarter and a growth rate over 3% in the third quarter. So a deceleration. And really came down to sluggish consumer spending. And as I had mentioned, it had to do with bigger ticket items like cars. There was another factor involved, which there was lower expenditures on home heating due to the winter being mild at times. And another big factor was businesses were not restocking their inventories in the quarter.
Now, a couple of these slides we will go through relatively quickly. You were talking earlier about the hard data versus the soft data, and what we're looking at here is more hard data oriented, correct?
Yeah, this is the Purchasing Managers Index, which is a survey of actual economic activity among manufacturers. That came in March at 57.2%, a half a percentage point off of its recent high. We did see very good growth among all industries, and we also saw good growth in new orders as well.
And sticking with the concept of hard data versus soft data, another hard data point is job growth, which was a bit disappointing.
Yeah, so the most recent numbers came in at 98,000. That was a little bit disappointing, below kind of expectations, and then on top of that, the prior 2 months were revised a little bit lower. Now, unemployment, though, did come in a little bit less than expected, and then we've also seen the total number of unemployed has also declined. The long-term labor participation rate has been flat, but I think while this isn't really fantastic, we've had many months of growth, and with that unemployment rate getting lower and lower, I think it's going to be tougher to see big job gains going forward.
Now, on the positive, earnings look to be rebounding, and we're obviously right now in the midst of the earnings season.
Yeah, and in fact, if you kind of look at where we were in the fourth quarter, that did come down a little bit from that third quarter number, but so far we're seeing pretty good numbers coming out of companies in the first quarter, and the expectation is that first quarter will be up as well as second quarter, and if this trend continues throughout the year, we'll exceed that high that we saw in 2014.
So now we're transitioning a little bit more toward the softer data. Everything that we've discussed thus far is a little bit on the hard data side. Consumer confidence, though, it seems to be leveling off. It had improved considerably. Where are the most recent numbers coming in at?
Yeah, the final estimate for April just came in today. It came in at 97. And I'll note that the prior number was 98, so it did come down a little bit in that final number. It's just off of its highs, and I'd say that what the best way to describe it, again, is that it's leveling off. And the 5-month average since the election has been 97.4%. So we're just a little bit off of that. Now, again, there's going to be that difference between the confidence people show in these surveys versus what they're actually doing with their dollars, and that's been a difference. The other thing we had mentioned a little bit in the last webinar was that there is a dichotomy between Democrats and Republicans in the Future Economic Expectations Index. That's come in a little bit, and that's been more of Republicans coming down with their expectations, but that's something to note because it could add a little bit more of instability in the month-to-month numbers, as well as what we're seeing in consumer spending.
Now, just generally, you mentioned earlier, the hard data has gotten a little softer. The soft data has shown a lot of improvement, maybe too much, and we see that here with the leading indicators indicating that growth, at least growth expectations, are still in the upward trend.
Yeah, and it's interesting. So in the first quarter, the LEI numbers actually kind of accelerated, and you can see that in the slope of the line. And what we've now seen is that in the most recent month, March, that was reported, 8 of the 10 components increased, and we've seen an acceleration in this index in the last 6 months. This suggests that growth will continue at a good rate with the upside potential out there. And again, that's potential. So again, this is a bit more soft, and we'll have to see whether this translates into better hard economic data.
Sure. And then usually we touch on small business confidence, which we've seen kind of a surge in, but it looks like that also has leveled off a tad.
Yeah, this is certainly one where when you look at other components that the National Federation of Independent Businesses track, we haven't seen other hard data improvements. We've definitely seen it on the index side. And I would suspect a lot of that has to do with the whole concept of tax cuts.
Sure.
That was one big difference for businesses in their outlook after the election, was this idea of potentially reduced regulations, lower tax rates, and so forth.
Well, and I think that leads us to a good conversation right now before we transition into the market discussion. If we just step back and think big picture from an economic perspective, we're 7 years into an expansion, which is a quite long expansion period. We also seem to be shifting from a less accommodative monetary stance to hopefully what will be more fiscal policy to propel growth. And what I mean by that is the Federal Reserve has started this interest rate rising cycle. So that's not going to be as accommodative as it has been in the past. On the flip side, to your point, we hope to see some tax legislation get passed that on a fiscal policy perspective could stimulate additional growth, even though we are 7 years into this expansion. So talking about taxes, everybody should know that the administration announced a new tax policy they'd like to push through and make legislation. I'm just going to touch briefly on the highlights of what the administration announced this week with that tax policy. From a business standpoint, they announced a reduction of the corporate tax rate from 35% to 15%. Now again, whether they can actually get that passed is maybe a little bit more questionable, but the proposal is anyway to go from 35 to 15, and a shift to more of a territorial tax structure with a one-time tax on the repatriation of foreign earnings. Another special note with regards to that 15% corporate tax rate, they indicated that that rate would also apply to small and mid-sized businesses and LLCs, which is a big change in the way that we've been doing it here in the past. So that's on the corporate or business side. On the individual side, they announced a reduction of the tax brackets from 7 different brackets to 3, including the 35% top bracket, 25% mid bracket, and the 10% lowest bracket. So that at the top end would be a reduction to 35% from the 39.6 that's existing right now. Now they didn't announce the income levels to achieve, you know, those brackets, but nonetheless that would be the bracket. They also announced a doubling of the standard deduction and the elimination of all itemized deductions other than charitable deductions and home mortgage interest deductions. So this one's going to be a big one. Again, questionable as whether it could actually get enough support to pass, but it would eliminate the federal deduction of state income taxes paid and of property taxes paid, which in certain states, Minnesota being a high income tax state, that could be a pretty significant change. Or if you're living in states like New York or California where the property taxes are exceptionally high, that could really impact you as well. And lastly, the administration announced that they would like to repeal the alternative minimum tax, the net investment income tax, and the estate tax. So we'll have to see how much of this actually gets through, but nonetheless, this is the first discussion of what the administration is looking for in a tax bill. So with that, let's transition into our discussion about the markets. And we see here the first quarter market results alongside the one-year trailing results. Obviously, everything, Jonathan, is looking pretty good on this page.
Equity market performance was very strong relative to kind of the idea of the economy showing only modest growth.
And I think the only real market during the quarter that was down was commodities, and we'll see the energy was, you know, obviously a big driver of that, which we'll talk about in a few minutes. Nonetheless, for the year trailing, commodities have recovered quite a bit. As we look at the breakout of growth versus value, we can see for the first quarter, growth-oriented positions, whether they be large cap or small cap, the growth-oriented positions definitely outperformed for the quarter. Now, for the year, that's not such the case. For the year, as we look back, value has definitely had an edge over growth. But again, the quarter rotated back in favor of growth.
And on this page, we'll look at kind of why there was that shift between the quarter and the year. So here we're looking at the quarter, and growth did lead. And so if you look at the bottom half, you'll see technology, consumer discretionary, and healthcare outperforming. That's really why growth had a good quarter. Now, if you look at the year, though, you'll see financials and energy, industrials, materials had good years. That's why value led. Even though when you look at energy at the top, it was the weakest performer in the quarter, but it still had a very, very strong year.
And how about international? What did we see in the international markets?
Interestingly, we saw much better performance in the quarter internationally. So here you're seeing, you know, double-digit gains for China, Latin America, emerging markets. Now on the right side, you'll see Europe and the UK. More modest returns, but again, very solid returns. And then when you look at the trailing one-year period, this is where you're going to see on the kind of left side, China, Latin America, emerging markets, very strong double-digit returns. But again, when you look at Europe and even the UK, good solid returns.
And we're going to touch on international toward the end of today's webinar, but we have encouraged our clients to remain diversified in international. Obviously, that has been a positive here more recently, even though for the prior couple of years, U.S. stocks had outperformed. I think a lot of people probably started getting too much home bias, meaning that, investors in the U.S. really believed that the U.S. stocks would outperform forever, and this has proven most recently that that's not the case, that international stocks, they still can provide a lot of value to a diversified portfolio. Let's talk a little bit about bonds, because unlike international stocks that have started really to come back pretty good, that really hasn't been the case with bonds.
Yeah, so this is kind of a tale of two cities, so to speak. If you look on the left side, emerging market, high yield, the recovery is a little bit stronger than the right side. That has to do with the left side is more credit oriented, and so we actually saw spreads narrow, which helped those bonds. And then on the right side, that was really more impacted by interest rates. And with the Fed kind of in a hike cycle, we'd expect that recovery to be a bit more modest. Now, when you look at a one-year return, you can kind of see that again. On the left side, which are more credit-oriented, much higher returns because those spreads have come down as people have perceived kind of global risk coming down. And then on the far right, you'll see that returns for the 10-year Treasury are actually negative on a one-year basis, and that's because of the increase in interest rates.
Sure. So I know we went through this information relatively quickly, but we're going to spend a few minutes just talking about SilverOak's outlook going forward, so that we can then discuss our market dashboard and a little bit more conversation around the international markets. So first, our outlook with regards to the U.S. economy.
So the expansion continues. So even though we've seen stronger soft data than hard data, we're still growing. We're seeing that trend in corporate earnings continue to look favorable. Now we do note that that's going to be somewhat dependent on oil prices in the U.S. dollar. And we'll actually address that in a couple of slides. And as we mentioned, there is that possibility for higher growth. But again, that's going to be somewhat dependent on some of these policy changes, whether they can get executed. So taxes, further deregulation, whether or not there's infrastructure spending at some point. And then lastly, inflation has hit the Fed's 2% target. So again, as long as growth is solid this year, the Fed will likely continue with their current policy trend.
And globally?
That's where, again, we're seeing some more interesting data. Global economic activity is definitely on a firmer ground. We're going to show later that data is actually becoming a bit more positive. We talked about China with kind of a positive arrow this quarter. That's helping emerging markets. That's helping commodities. Even though in the quarter energy was down on a performance basis, for the year we're still seeing higher commodity prices. And then globally, monetary policy is still accommodative, a little more so than what the U.S. will be. But the last item is that there's still some political uncertainty. Now, obviously, the French election results that came out over the weekend were perceived by the market as being positive, but there's still a runoff election in 2 weeks.
Right. Which gets us into the discussion about the dollar, and we talked a lot about in today's webinar about having international exposure. We're going to talk a little bit more about that in a few minutes. One of the downsides of having some international exposure over the last couple years anyway was the fact that the dollar continued to strengthen, which made it difficult for some of those international positions. But we're starting to see that level off. And I would suspect, in turn, because we're more optimistic about the international markets, they're not going to have, hopefully, as big of a headwind as had been the case with the currency. Is that
Yeah, that's
fair
kind of the
assumption?
expectation.
Yep.
So that's something we'll have to watch, because obviously if the dollar kind of goes on a new uptrend, that would detract from international performance.
And we talked about the energy sector already, but this is essentially showing the fact that we're really coming off the lows as it relates to energy contributing to the S&P 500 earnings, and it looks like we're on a new uptrend, even though for the quarter again energy pulled back from a market perspective.
Yeah, so second half of 2015, when oil prices collapsed, energy company earnings and their suppliers, those earnings collapsed. We did see those become less negative in 2016 and turn a slight profit by the end of the year. The expectation is this quarter we'll see a bit more growth, and from that standpoint, we're starting to see some evidence of that. Exxon and Chevron just reported their quarterly earnings. Exxon had a strong quarter, and Chevron swung back into profitability. And it's not that activity levels have really spiked. It's more of the fact that oil prices are 55% higher than they were last year, and so they realize more earnings on their current activity.
So let's talk a little bit about SilverOak's outlook for the markets, and not just really the economy. And I know market performance, as we've seen, even in the data that we showed today, has broadened beyond what some would kind of coin the Trump trades. And we could have further market upside driven by this discussion around corporate earnings. Now, frankly, we also talked earlier about the tax reform and how that could bolster earnings, and therefore earnings could drive valuations even higher because we simply get lower taxes. That's going to contribute to the higher corporate earnings, which we would hope would contribute to higher valuations. We talked a little bit about the legislative and foreign policy uncertainty. I literally just walked past the TV a few minutes before we started the webinar, and I saw in big red letters discussions about North Korea. So we always have those black swan events that are out there that you just can't necessarily plan for, but nonetheless we got to be cognizant of. So positioning as it relates to the equity markets.
This is a case where, again, with growth where it is, we're seeing some improvement in corporate earnings. It's hard to differentiate. Therefore, having that diversified mix across equity sectors, large, small, and mid, between growth and value, because we've seen that kind of handoff in the short run between growth and value. We've also mentioned, and we'll talk a little bit further, that international equities offer compelling valuation and their fundamentals are improving. And then the other thing we had also mentioned from an economic standpoint is that inflation is at that 2% target for the Fed. If we see that continue to go up, we're going to see commodities and other sort of real asset types of investments will do better than they had in the prior 3 to 4 years.
Well, you mentioned the value versus growth performance, and earlier we saw the chart where for the quarter, at least the first quarter, growth outperformed value. For the full year, looking back, value actually had a slight edge, but that was really one of the first years that value edged out growth in performance. But here what we're showing is that if we look at large cap U.S. stocks, the blue line represents the large cap growth minus the large cap value component. So if you're looking at the red line going across, that's kind of equilibrium. And you'll have to help me with the colors because I am colorblind, but I think it's a brownish bar at the top, line going across. That's kind of the top of the trading range, and the grayish bar at the bottom is the bottom of the trading range. So am I explaining this right, Jonathan?
Yes,
You got
absolutely.
my colors right?
Yeah, and another way to think of it is when that blue line is going up, you're in a growth cycle, and when that blue line is going down, you're in a value cycle.
Perfect. So what we're showing here then is growth relative to value is high in its valuation right now. And you would expect at some point, although it could continue to go up, at some point that will rotate back more to the mean and value will outperform more consistently over some period of time.
Yeah, and that has implications to investments, because there have been some studies that have shown that when growth is outperforming value, passive investments tend to do well, and vice versa. So that's an important trend that we've seen in the last few years, where active managers have had a very, very difficult time relative to meeting market benchmarks.
Yep. And what we're seeing here is the U.S. large cap market, but we actually see it similarly, and maybe even more pronounced, in the U.S. small cap market, where again, growth has been heavily in favor, and maybe at the top end of the trading range, looking back historically, which would lead us to believe that value is about to come back in favor. And to your point on the active versus passive, as value comes back in favor, so does active management relative to the benchmarks. And this is a slide that's actually showing us that active versus passive component, and indicating that we're kind of at a high right now with active managers underperforming.
Right, and now on this slide specifically, we're looking at a large cap passive investment. It's an index of large cap companies, and the blue line is actually showing how that passive investment is ranking relative to peers. And so what you're seeing is that its peer ranking is in the top 10%, meaning that it's beating all but 9%.
90%.
Yep. So it's beating 90% of the active managers. Now, there's a couple things I think that can be gleaned from this chart. One is that when returns are high, you'll notice that that peer ranking is very, very high. And then when you see that returns are lower, then you're actually seeing the peer ranking again lower, meaning that more active managers are doing better. And so again, we're at that peer ranking level where that's tended to reverse in the past. And so again, that if that were to happen, again, if value were to start to make a longer term comeback, we again would think that the peer rankings for active managers would start to improve.
And just to clarify, here at SilverOak, we're pretty much agnostic on this discussion on active versus passive. We're really just trying to find what's best for our clients without a strong bias on one versus the other, and we allow the data to kind of take us to where we believe we should be. In certain categories, we use more passive investments than in other categories. Like in international, we don't really use much passive, a little bit, but not much. Whereas maybe in the U.S. large cap growth market, we probably use a little bit more passive than in the international market. All right, so let's now talk about SilverOak's outlook for bonds or the fixed income markets. And here you're saying that the bonds, Jonathan, are trading in a range.
Yeah, now that range is higher than we would have seen early last year. So one of the things that we did see last year is that yields bottomed at low historical levels in July, rose a bit ahead of the election, and then we saw them increase a bit more into the first hike in March for this year, and then have since actually backed down. So that range is probably about 2% on the low end for the 10-year Treasury, and kind of in that 2.75 to maybe 3% on the high end, meaning that the bond market is pricing in the rate hikes.
Sure.
They're not surprised by the policy, and so from that standpoint, things have settled down a bit.
And as far as positioning?
Well, we still believe that bonds offer protection when stocks are more volatile. So we've talked about interest rate increases being likely this year, but one of the things we also talked on the outlook for stocks is that there are legislative outcomes that are unknown. We have wild cards from a foreign policy perspective, North Korea, and so we saw very, very little volatility from the election through early March. We think that there will likely be more volatility going forward because we're kind of entering a stage where there are different possible outcomes. So if we were to see a pullback in stocks, as an example, because of that heightened volatility, then bonds actually would hold up relatively well.
And I think that's an important takeaway. As I look back on, or even think back on our discussion thus far, a couple of things come to mind. One is that international exposure again, but the other is if I look through the return slides, I would see that bonds have not returned that much over the last year. And if interest rates go up, the concern is that they will continue not to provide that much return, whereas the stock market's been kind of on a tear. However, we have to put everything back into perspective and not get too grounded in the recency bias, because going back to the crash of 1929, the average bull market for the stock market is 55 months in duration with a 156% return off the bottom. And this is measuring the U.S. large cap market. The current bull market we're in on equities is 98 months long with a 249% return off the bottom. And as I mentioned earlier, we're 7 years into this economic expansion, which is a long period of time. Added to that, a 10% correction in the markets typically happens on average every year. A lot of people don't know that, but typically every year there's a 10% correction. We haven't seen one of those corrections since early 2016, at least not in the large cap markets. There's a 20% correction on average every 5 to 7 years. We haven't seen one of those since 2008. Now, we did have a 19% pullback in 2011, but it didn't quite meet that 20% threshold. So bonds, my point being, we still are very pro-diversification, and diversification includes, for most clients, some component of their portfolio being in bonds. Even though you may say, theoretically, they may not have great returns going forward, that can all change for a variety of reasons, including valuations on the equity side.
And I'd also point out, though, that we maintain that you should stick with high-quality bonds.
Good point.
You can buy lower-quality bonds that offer higher returns, but we believe kind of where we are in this cycle, that's not a very prudent thing to do.
Very good point. So with that, let's transition into a discussion around the SilverOak Market Dashboard. And I want to start first by outlining the purpose of the dashboard. And as we think about this dashboard, I guess the one thing I really, really want to drive home is what it's not used for. And I'm going to start with that, because it's not used for market timing. Everybody that we work with, they know we do not try and time the markets. That is a loser's game. Not even the best investors in the world try to time the markets. They invest for the long term. Instead, the dashboard is a tool that provides us kind of an overview of the U.S. economy and markets. And we're continually reassessing the tool and modifying the tool, but we're using it hopefully to help provide an unbiased way of assessing the current environment that we're in, to try and pull out some of the biases that we otherwise could play into or allow being played into kind of our assessments. The dashboard is composed of 4 equally weighted components. So we're going to touch on those components right now. We first have the economy that we measure. Then we have credit markets. Then valuations. And the 4th component is market sentiment. So we have, kind of getting back to our earlier discussion, Jonathan, hard and soft data. This particular chart shows the quarterly data going back for the last 3 or 4 years. I should note that we are showing second quarter, third quarter, and fourth quarter of 2017. These are basically projections utilizing the current trends of the data and then making some adjustments to try and shift them down a little bit more conservatively. But I would not necessarily take these second quarter, third quarter, and fourth quarter data and say that this is really what SilverOak is expecting to occur. It's just using the data that we've seen and projecting it out based on a similar trajectory. Okay? Anything to add to that, Jonathan, just so we don't confuse?
Another way to think about that also is that we know that trend of data, so we also know how the data would have to change that trend line.
Yes.
And that's a good way for us to think about the data as well.
So if we look here at the first quarter, and by the way, I should also mention, I almost overlooked it because I am colorblind, so I have just a heck of a time with some of these charts. But I've been told that there's green, gray, and a pinkish or reddish square as we look at the chart. Green stands for positive or good data. Gray is neutral, and the pinkish or reddish is more negative or not so good. So as we look down the first quarter column, we can see the economy, it's positive. The credit markets, overall positive. Valuations, not so good. And that means that valuations are high, so as we look forward, it's maybe not so good that we're going to continue on the same trajectory of market returns because of the high valuations. And then, of course, market sentiment is in the good category. We take these 4 components and we create a composite. And you can see the composite at the bottom. Now, if we want to look back to see what these looked like over the last several years, or at least over the last period of pullback, which was the Great Recession, we can see the economic data started coming in a little weaker in the latter part of 2006. The credit markets, similar story. Valuations, this is an interesting one because valuations actually didn't look good until 2009. But if you think about it, it makes sense, right? If the market is going down in 2007, certainly 2008, well then future valuations must be looking better because you can buy cheaper today. And of course, market sentiment had started to shift a little bit down. Then it shifted more positive in 2007, and then obviously fell off, kind of fell off a cliff. And we have the composite data for each of those quarters or years as well. Now, if we dissect this just a little bit more, Jonathan, I said that there were these 4 components, but really we break those components into many subcomponents. And here we're just showing a sampling of what those subcomponents might look like.
In fact, so the ECRI index, the LEI ISM, those are soft data points. Corporate profits, GDP, those are hard data points. If you look at the credit markets, we're looking at the fixed income markets, we're looking at the shape of the yield curve, those spreads between safer bonds and higher risk bonds. And so on this slide, we wanted to just kind of drill down and look at corporate profits.
So this is a subcomponent of one of the components that we talked about, the
right, absolutely.
economy.
And so what you'll see on this page is in blue is the performance of the S&P 500, and then in that kind of brownish color, you're looking at the operating earnings for the S&P 500 companies. And really to glean is that the markets tend to follow the overall trend in earnings. And so we've seen earnings recover in the last couple of quarters, and we've seen the markets come up as a result. This isn't really looking at valuation. We're going to do that at another point. This is just to show that why stocks tend to go down in recessions. Mm-hmm. Part of that is that corporate earnings go down. And when you really think, the theory behind the value of a company is it's the value of the cash flows it earns. And so that's why we think that earnings are important and why it's a good component within the economy portion.
And this really touches on back to the discussion about taxes. If we do see those reductions that we talked about earlier, that could drive earnings, which even though valuations currently are high and in our dashboard showing that they're not so good because they're so high, if we do see that expansion of earnings, we could see those valuations continue to rise. Now this is the third and fourth components of the dashboard, the valuations and the market sentiment. And of course, just like with those earlier two components, these have subcomponents as well, such as the trailing PE or the Shiller normalized 10-year PE, and then of course the various components of the or subcomponents of the market sentiment.
Yeah, the thing I'd add about market sentiment is think of this as a trending component. When the trend is positive, it's basically telling you the markets and the economy are positive. So that's really the most important thing to be gleaned from that.
Yeah, and I guess before we go to the next slide, the other component that we've touched on, but you can really see it quite clearly here, is all of the pinkish or reddish squares up under valuations, showing that valuations are high, but that gets us back to the earnings discussion.
So on this slide, we're looking at that Shiller PE, which is looking at the earnings of the last 10 years and then basically looking at valuation from that standpoint. We're above average. That's that brownish line. But what you can really see is that since the early 90s, we've been above that average except for during the Great Recession. And so I think the answer here is that valuations can be elevated for many, many years. So it's not a timing tool. It just kind of tells you where you're at.
Sure. And to that point, when we look here at the S&P 500 forward 10-year returns based on earnings yield, if we're right now at an earnings yield at about 4 to 6%, so valuations are a little high, pulling the earnings yield down to about 4 to 6%, then the future expected 10-year returns are in that 4.6% range. Is that correct way of
that's a correct
interpreting
way
this?
of looking at it. And again, this is just for the S&P 500. And so from that standpoint, that's not a high number.
No.
But you have to remember there's small caps, there's mid caps, there's international. Those have different return expectations. And so to give you kind of a historical perspective, in the 10-year period ending in 2009, we've kind of in the past called that the lost decade. And that was because prior to the depression in the 30s, this was the lowest return the S&P 500 has seen. It was a -1% annualized during that decade. But if you had a diversified portfolio of different types of stocks, you actually showed returns during that period in a 4 to 5% level on equities. So this is just one part of an overall equity portfolio.
And probably another good argument for having that small cap exposure and the international exposure, et cetera, et cetera. So again, just bringing us back to the market dashboard, we have the four components that then get totaled into the composite at the bottom. What we're showing here is the composite number then going back in history. And probably really all you need to focus on is one, the blue line being the S&P 500, and then the other two lines, just think of them as the composite number. And what you'll see is when that composite starts to go down, like in 1998, we saw quite a significant drop in the composite. Shortly thereafter, we then saw a drop in the S&P 500. Now, it's not perfect correlation, and that's why we don't use this as a market timing tool. Of course, it's also not always directionally accurate. But if you look at that 3.25 level over on the right side of the screen, that black line that's going across is at about 3.25. Once the composite drops below that, that is a signal anyway that we should be cognizant of a possible shift in the markets. Most recently, we've seen the composite total number come down. That has nothing to do with whether the market's going to pull back or not. But if we do see that composite come down below the 3.25 and stay there steadily over a quarter or two, and the market still hasn't pulled back, I think that would cause us a little concern, or at least a little pause in what exactly is the data telling us for future market returns.
And the other thing I'd add is that being below that composite 3.25 tells us the environment isn't as positive, suggesting that stocks could pull back, but we've also seen that at that level bonds could outperform stocks.
Good point. Good point. And looking back in 2014/2015, we saw that composite fall below the 3.25. We did see some short-term volatility in the S&P, but it was relatively short-term, and then we get this big bump up in the S&P. So we have to be a little bit careful in how we're interpreting this, but it does give us a general guide. Now, the biggest downside of the dashboard as we have it structured currently is that it's all U.S. oriented. And we have to be careful not to extrapolate what we believe in the U.S. is going to occur, that will occur in the international markets or within the international economies similarly. We've already mentioned the international markets outperformed last year. So if you look at this chart and you see the bars going down, those are years in which the international markets outperformed the U.S. markets. If the bars are in the upward trend, that's the U.S. markets outperforming the international. So last year, obviously, international slightly outperformed. And that's being driven off of more positive data that's coming out of these international markets. And I know this slide is ridiculously busy, but I think what we're really just trying to get across is on this heat map of all the different international markets or countries, we're seeing less red, less yellow, and more green. That's a positive sign.
And in fact, if you look on the far right, you're going to see a lot of green on the top half of the heat map. And coincidentally, that's Europe. And so we've seen definite improvements economically in Europe despite Brexit and the concerns from a political standpoint.
And to further support the international argument, we're showing here the earnings per share. And we can obviously see that in the U.S. markets, quite high, while in the international markets, they haven't seen that recovery that the U.S. has seen.
And so if you look at that bluish color, that's Europe. And so in that 14 to 16 period where the U.S. earnings were down a little bit, they were definitely down. If you look at the purple emerging markets, they were down even more. And so what we've seen starting in 16 coming into this year is Europe is kind of coming up off of that bottom. We've had an improvement in the emerging markets, and I don't think it's really a coincidence that we've seen, with the dollar being kind of in check, that emerging market returns last year were fairly strong, and we're starting to see that shift towards general international, which has a bigger European component.
Yes. And of course, this goes through the valuations. So we just looked at earnings. This is valuations, just indicating that the U.S. markets are higher in valuation than their historical averages. And although there's components of Europe maybe that aren't necessarily really cheap, they're not necessarily as high as the U.S. relative to history.
And then on top of that, if we do see an earnings acceleration in Europe, that will add to that return even if valuations expand a little bit.
Yeah, good point. So with that, let's get into our reminders, and then we can wrap up right on time. And again, the reminders are just being shared since we are conducting our first webinar for the year. It's a nice way to get things started. Make sure everybody that has required minimum distributions, make sure everybody that has those, that you're processing those. If you're a SilverOak client, of course, we're processing those on your behalf. Those are mandatory distributions that the IRS says have to come out of IRAs at certain periods during your lifetime. Also, make sure that your first half Minnesota real estate taxes are paid if you're at least a resident of Minnesota and you've got real property here. Request a copy of your credit report. We love everybody doing this every year. You can do it online at this website, or even a better way is to call. Oh, I didn't put the phone number here, but you can call 877-322-8228. 877-322-8228. That's the government-sponsored call-in line, and if you wait a few minutes or maybe 15-20 seconds, the system will allow you to do a push-button request for your credit report to be mailed to you. Of course, tax season is over. Yay! Gotta love the end of tax season. But remember, now is a great time to start putting together all of your tax records for 2017 tax year. So keep a nice organized file of charitable contributions and anything that would relate to your 2017 tax return preparation. And with that, also remember the IRS will never call you. There's a lot of identity theft happening these days. And if you ever get a call from somebody that says they're with the IRS and you need to share information, or they're going to initiate litigation against you, etc., hang up the phone, because the IRS does not call with those types of issues. You would receive something that would be official mailed to you. So again, if you have any questions ever, feel free to reach out to us, talk to your SilverOak advisor, and we can help you through that. If you have any questions, also feel free to reach out to your SilverOak advisor. If you're not currently working with an advisor, you can call me directly at the number on the screen. It's 952-896-5701. And with that, Jonathan, we're right at our 60 minutes. I appreciate everybody joining, and have a great rest of the day.